This right here may be one of the most important videos I've ever made about a topic you've likely never heard anyone else talk about. You're going to find out why investing in US-based ETFs and even US stocks could be a bad idea for most European investors in the long run. A lot of it has to do with taxes, not only during your holding period, but even if you were to die and pass on the investment portfolio you worked so hard to grow to any loved ones that are left behind. In fact, you could lose as much as 40% of your stocks and ETFs value if you don't pay attention. This is absolutely vital information you need to be aware of, so let's not waste any more time and get right into it. Let's start by quickly comparing US and Europe-based UCITS ETFs. I do get the appeal of wanting to buy ETFs domiciled in the United States. They're often broader or cheaper than their European counterparts. Just look at the American Vanguard Total World ETF. It contains an astounding 9,961 stocks from all over the world, including emerging markets, and comes with an expense ratio of only 0.07% per year. Meanwhile, Vanguard's closest Europe-domiciled counterpart, its popular FTSE World ETF, only contains around 1/3 the number of stocks, while costing more than 3 times as much, 0.22% per year. And yes, it's true that we have competing ETFs in Europe now which have pushed fees considerably lower. In fact, I made a video about this exact topic and why I started buying Invesco's FTSE World ETF recently, which you can watch after you finished with this one. That being said, US-based ETFs are generally still less expensive across the board, especially when you're looking to add small cap, mid cap stocks or factor ETFs like value and quality to your portfolio. Not only that, there are countless ETFs which are missing European counterparts completely, like the popular Schwab US Dividend Equity ETF, aka SCHD, which I often get comments about, or VTI, the Vanguard Total Stock Market ETF, which doesn't only cover the top 500 companies in the US, as is usually the case via S&P 500 ETFs, but a total of 3,656 US stocks. All of this while still only charging 0.03% per year. And lastly, US ETFs tend to have higher volume on exchanges, leading to tighter spreads and often come with lower trading fees. Speaking of low trading fees, you can find the best low-cost brokers in Europe for stocks and ETFs down below in the description, which is a great way to support me if you'd like to. Now, if you're based in Europe, chances are you can't access US-based ETFs in the first place due to EU regulations which were implemented in 2018, unless you go out of your way to find a US brokerage account that still takes European investors. But in that scenario, you're usually forced to wire money back and forth to an American bank account, which ends up costing you a lot in fees long term, negating any potential benefit you may have seen in the first place. Now, you may feel like that's unfair, which I totally understand, but you'll soon realize you may not want to hold US-based ETFs anyway, and here's why. Reason number 1 to avoid US ETFs. They are not available as accumulating versions. UCITS ETFs domiciled in Europe come with some advantages. For example, did you know there are no accumulating ETFs in the US due to different tax laws, while they are generally the most popular by fund size in Europe? As I've previously discussed in a video where I compared taxes on ETFs across Europe, which you can watch afterwards, accumulating ETFs come with a major tax advantage in most European countries. And just to refresh your memory, accumulating simply means that the ETF reinvests the dividends it receives throughout the year from the stocks it's holding into more shares of those stocks instead of distributing the dividends to ETF investors in cash. Speaking of dividends, this brings me to reason number 2. You may be forced to pay more in withholding taxes. Unless your country has a tax treaty with the US and unless you make sure you fill out the W-8BEN form with your broker, you may have 30% deducted in withholding taxes whenever US-based ETFs or US stocks pay out dividends to your brokerage account. Meanwhile, ETFs domiciled in Ireland benefit from an advantageous tax treaty, cutting withholding taxes on US dividends in half to 15%. Sadly, this is not the case with ETFs domiciled in Luxembourg, so I would avoid this fund domicile if your ETF physically holds US stocks as well, as it's likely to underperform even if it has a lower total expense ratio. Reason number 3. You may lose a large percentage of your holdings due to US estate tax once you pass away. Sorry if this sounds a bit morbid, but this is something you need to be aware of, especially when considering that US stocks, particularly those from the tech sector, are some of the most commonly held single stocks across the world. US estate tax is by far the most important reason why you may want to avoid holding United States-based ETFs or even single US stocks with a total value of over $60,000. The last thing you want is to spend your entire life growing your investment portfolio with your hard-earned money, only for your loved ones to then lose up to 40% of the total amount due to US estate taxes when you pass away. Yes, you heard it correctly. In this case, the tax is charged on the total value of your US-based assets, not only on the profits. Here's how it works. US residents currently only have to pay estate tax if their assets are worth more than $13.61 million. But if you're a non-US investor living outside of the country and you hold US stocks, locally domiciled ETFs, or real estate in the country, your tax exemption is ridiculously low at only $60,000. And let's be honest, for most investors, that amount is not hard to surpass when you consider your portfolio's growth over time. The amount above the $60,000 exemption is then taxed at up to 40% by the IRS when you pass away. So if, for example, you have US assets worth $1.2 million and you thus fall into the highest estate tax bracket, you risk losing $456,000 in taxes to the US, with your loved ones being left with only $744,000 once you're gone. If we're talking about half of that amount, $600,000, the US government still takes a hefty 33% cut, leaving you with only $400,000. And here we haven't even considered any potential inheritance tax in your home country yet. Okay, but what if my country has an estate tax treaty with the US? If you're lucky to live in one of these 15 countries across the world that currently has a relevant treaty with the United States, you may be in a better position. The way these treaties seem to be set up is that you get a proportional share of the large US estate tax exemption US residents get. To calculate it, you need the total amount of all of your assets converted to US dollars and a proportion of these that are US based. So to simplify, let's say you have a total net worth of $1 million with $300,000 in US stocks, $300,000 in an MSCI World ETF domiciled in Ireland, an apartment in Europe worth $300,000, and $100,000 worth of cash sitting on a European bank account. Since your proportion of US assets to the total is 30%, you get 30% of the $13.6 million estate tax exemption a US resident would get, so $4.08 million. Since your US assets are worth quote-unquote only $300,000, so much less than $4.08 million, there is no tax to pay to the US government. Having said that, if you do live in one of the 11 countries that currently have an estate tax treaty with the US, your inheritors will need to submit a US estate tax return within 9 months of your passing, proving your place of residence and the total value of your assets. Otherwise, you may lose the benefits of your country's treaty completely. Not only that, access to your US assets may be frozen by the IRS until the estate tax return is submitted. There's one more thing you need to keep in mind here. What if you ever decide to move to another country that's not on the list, perhaps later on in retirement? What if you wanted to spend the rest of your life in Portugal or Spain, for example, as you get older? Well, sadly, neither of the two countries have an estate tax treaty with the United States, so US assets with a total of over $60,000 would once again need to be taxed at up to 40%. Alright, let's do a bit of a recap and figure out the best solution. First off, I would advise most of you to stick to ETFs domiciled in Europe and especially Ireland if your ETF contains US stocks. This way you're able to benefit from a lower withholding tax of 15% on US dividends, as well as a large selection of accumulating ETFs which come with major tax benefits in most European countries. But the most important benefit is that any loved ones that inherit your shares never have to go through the headache of dealing with US estate taxes, potentially losing up to 40% of the assets to the IRS. Look, as long as your ETF is based in Europe, it doesn't matter if you're holding €1 million or more worth of it, even if it's fully made up of US stocks like an S&P 500 ETF. All that matters is where it's domiciled. Since that's not the US but Ireland, there's no risk of estate taxes. And second, if you enjoy investing in single stocks, which you have every right to, please make sure you fully understand the potential tax implications I shared with you today when you hold more than $60,000 worth of US stocks. Looking at my YouTube analytics, I can already see that 12 out of the 24 countries I get the most views from don't benefit from an estate tax treaty with the US. This means that many, if not the majority of you watching, need to be very careful when dealing with single stocks, ETFs, real estate, or other assets based in the United States. You do not want to risk losing a large percentage of your portfolio to the silly tax, which doesn't even account for any inheritance tax your own home country might charge on top of it. And no, sadly, your broker choice does not make a difference here. Now, let's say you're living in one of the 11 European countries with a favorable US treaty and therefore currently prefer US ETFs or single US stocks. In this case, I would still like to remind you that you may be limiting your options for the future. For example, what if you wanted to move to another country that's not on the list later on in retirement? Once again, your US assets would be exposed to the risk of high estate taxes. You should keep all of this in mind when making long-term investment decisions. decisions. When I think back a few years ago, I remember being upset that the EU implemented rules making it close to impossible for us European investors to buy US domiciled ETFs. But now, having researched this topic in more detail and finding out that most European investors will be forced to pay ridiculously high estate taxes to the US when passing away, the regulations that were put in place do seem a lot more justified. Some might even say protective. But I would love to know what you guys think. Were you aware of US estate taxes before watching this video? And if not, is this going to influence the way you invest? Let me know in the comments. Before I take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. If you'd like to support me, feel free to use my links to the best local brokers in Europe for stocks and ETFs down below in the description. Also, please keep in mind I'm not a tax advisor, I'm just a European investor myself, so please forgive me in case you find any minor mistakes in this video. Thank you guys so much for watching, have a wonderful day and until next time.